Wait, did Ripple just unlock the trillion-dollar real estate market and trigger a financial infrastructure shift that could ripple, quite literally, through global banking, all in just 1 week? To the casual observer, XRP's recent dip under $3 might look like just another retracement in a volatile crypto market. But zoom out and a much bigger picture begins to form. Behind the headlines, behind the charts, institutions are moving. Quietly, methodically, relentlessly. Ripple, a company once mocked for being too centralized, has now laid the groundwork to become the backbone of real-world asset tokenization, the very thing that legacy finance has been racing to control. And what's unfolding right now may go down as the weak XRP crossed a point of no return, from speculative asset to digital infrastructure of the next global economy. Let's unpack the layers. This week alone, 3 seismic events dropped like dominoes: a landmark deal in Dubai to tokenize real estate on the XRP Ledger. US regulators, yes, the Fed, FDIC, and OCC, finally aligned to allow crypto custody by banks, and an XRP ETF approval that, while still futures-based, has sent signals echoing through Wall Street. At the same time, XRP burns have exploded by 100%. On-chain volume has surged into the hundreds of millions, and a macro-cycle analyst has identified $3.65 as a critical threshold, not just a resistance level, but what he calls the Valhalla gate. This isn't retail FOMO. This is the institutional era of XRP, stealthily entering its first stage of deployment. And it all begins in Dubai. Dubai has never been shy about the future. From AI-powered governance to flying taxis, the city-state has consistently positioned itself years ahead of global trends. But now, it's laying the foundation for something even more profound, a tokenized economy built on blockchain infrastructure. And at the center of it all, Ripple and the XRP Ledger. This week, Ripple inked a groundbreaking deal with Control Alt, a licensed digital asset firm under Dubai's VARA, to tokenize and store property title deeds on the XRP Ledger. This isn't just a pilot, it's a production-level integration that brings multi-billion-dollar real estate assets on-chain, regulated, compliant, and ready for institutions. Let's be clear, property tokenization has been a buzzword in crypto for nearly a decade, but buzzwords don't change legal frameworks. Infrastructure does, and Ripple isn't offering just a blockchain. It's offering a financial-grade operating system, complete with institutional custody, lifecycle management, and regulatory trust for one of the world's most valuable asset classes, real estate. Here's how it works. Control Alt builds the user-facing layer, a seamless interface for listing, trading, and managing real estate assets. Ripple provides the rails, a custody-grade blockchain where property deeds are issued, transferred, and tracked immutably on the XRP Ledger. The Dubai Land Department, a government body, provides legal oversight, making this a fully recognized transition from paper to protocol. Every property title token created is a legally enforceable digital asset, and each one adds utility and trust to the XRP Ledger. But this isn't just about tokenized ownership. Ripple's real estate entry opens the door to fractionalized investing, real-time settlement of multi-party deals, transparent ownership history, and programmable contracts embedded directly in property titles. This transforms real estate from a friction-filled, slow-moving industry into a high-speed financial instrument, one that can be bought, sold, transferred, or collateralized like any other digital asset. And all of this is happening not in a theoretical white paper, but in one of the world's most forward-thinking economies, backed by legal authority and regulatory clarity. More importantly, this isn't Ripple branching into new markets. This is Ripple executing its original thesis, to become the infrastructure layer for regulated value flows across borders, sectors, and asset classes. The XRP Ledger just became home to real estate, and that changes everything. While headlines screamed about ETF approvals and price dips, something far more profound quietly unfolded in the US financial system. In a joint statement that slipped under the radar, 3 of America's most powerful regulators, the Federal Reserve, the FDIC, and the OCC, issued unified guidance that authorizes US banks to custody digital assets. This is the kind of move that redefines financial architecture. For the first time, traditional banks, from small regionals to global giants, have regulatory clarity to hold cryptocurrencies on behalf of customers. That means institutions like Wells Fargo, JP Morgan, and Bank of America could now offer direct custody of digital assets like XRP, not just through third-party custodians. And this isn't just symbolic. The statement defines safekeeping, with or without fiduciary responsibility, as a core banking function. Translation: banks can now act as crypto vaults, regulated under the same framework as they are for fiat assets, precious metals, and securities. Why does this matter for XRP? Because while Bitcoin and Ethereum are designed for decentralized use, XRP was built for banks. Its architecture, from 3-second settlements to built-in compliance hooks, was engineered to serve the very institutions that are now being invited into the crypto custody world. Ripple didn't just anticipate this shift, it prepared for it. The company already applied for a U.S. national bank charter, aiming to become one of the first blockchain firms with direct access to the American banking system. If approved, Ripple would effectively become a crypto-native bank, with custody, settlement, tokenization, and compliance all under one roof. But even beyond chartering efforts, Ripple's infrastructure is already being plugged into legacy banking rails. Take RLUSD, Ripple's US dollar-backed stablecoin. It's now being integrated into BNY Mellon's custody platform, one of the most trusted financial institutions in the world. Ripple isn't chasing trends, it's building a financial stack for institutions, one that's compliant, scalable, and ready for the trillions of dollars that still sit on the sidelines. And the timing couldn't be better. With this new green light, banks no longer need to fear gray areas. They can now custody XRP directly, offer it to clients, or use the XRP Ledger to build tokenized products with full regulatory backing. This is the formal institutionalization of the crypto industry, and XRP is the blueprint they're following. The quiet part? Most of Wall Street hasn't realized it yet, but they will. And when they do, XRP won't be an alternative. It'll be infrastructure. While price watchers fixated on the Genius Act vote and a minor pullback, something far more seismic was quietly setting the XRP community on fire. The ProShares Ultra XRP ETF was officially approved by the SEC. Yes, it's a futures-based ETF for now. But make no mistake, this is the foot in the door. For years, XRP holders watched from the sidelines as Bitcoin and Ethereum dominated the ETF spotlight. Now, XRP has its own institutionally traded product listed on NYS Arca, and that milestone means more than just price speculation. The ETF seeks to deliver 2x the daily performance of the Bloomberg XRP Index, a high-risk, high-reward vehicle that introduces leverage into institutional XRP exposure. No, it doesn't hold XRP directly, but it puts XRP on the radar of fund managers, desk traders, and high-frequency quants who trade these derivatives by the billions. But here's where it gets intriguing. Insiders are now whispering that ProShares is just the beginning, and that a spot-based XRP ETF may not be far off. In fact, Grayscale, the same asset manager who forced the SEC's hand on the Bitcoin spot ETF, has included XRP in its Digital Large Cap ETF, GDLC, application. And while the SEC issued a stay to delay its launch, Grayscale filed an official rebuttal. Why does this matter? Because in 2023, Grayscale successfully sued the SEC to overturn its denial of a Bitcoin spot ETF. That win triggered a domino effect, leading to BlackRock, Fidelity, and others launching their own ETFs in 2024. If that playbook repeats, and XRP is included in the GDLC or any future spot-based product, we're no longer in the realm of retail hype. We're looking at institutional-grade XRP accumulation through regulated markets with trillions of dollars in dry powder ready to deploy. And that brings us to the number XRP analysts can't stop talking about, $3.65. According to macro cycle analyst Egrag Crypto, this isn't just a resistance level, it's the Valhalla gate, the threshold that, if breached with confirmation, could unleash a surge to $12, $15, even $23. That might sound bold, but Egrag's framework is rooted in monthly charts, macro Fibonacci zones, and multi-cycle symmetry, the same kind of long view models that correctly predicted Bitcoin's $60K breakout years before it happened. In his view, $3.65 represents the mid-cycle top from a previous XRP structure. A confirmed monthly close above it would signal that XRP has moved out of accumulation and into expansion, the exact phase where Bitcoin went from 3K to 60K in 18 months. Already, XRP has broken out of a bullish pennant, bounced off the 9-month SMA, and held above all major EMAs. Add to that, on-chain burns are exploding, payment volume on the XRPL is surging, and XRP is trading just below $3, consolidating against the resistance like a coiled spring. This isn't just technical, it's strategic. The ETF buzz, institutional custody approval, and Dubai real estate integration are converging, all while XRP holds the line against macro resistance. If $3.65 breaks, the institutional floodgate opens, and the long-promised XRP breakout may finally become reality. While traders obsess over candles and headlines, the XRP Ledger has quietly been burning tokens at twice the usual rate, and for seasoned observers, that's a signal worth paying attention to. On July 15th alone, over 4,500 XRP were destroyed in transaction fees, marking a 100% increase in token burns over the past week. Now, this might seem minor compared to XRP's 59 billion circulating supply, but it's not about size, it's about structure. Here's why this matters. Every XRP transaction comes with a tiny burn fee, permanently destroying a fraction of XRP to prevent spam and add economic weight to usage. When activity surges and fee burns double, it means real utility is ramping up on-chain. And that's exactly what's happening. Over the last 30 days, payment volume on the XRP Ledger hit a peak of over 471 million XRP per day. That's not wash trading or manipulation. That's genuine, validated throughput, the kind Ripple has spent years engineering for cross-border payments, stablecoins, and now real estate tokenization. Even more telling, this spike in burns is preceding price, not following it. While XRP consolidates just below $3, the chain is already behaving like a network preparing for expansion, not collapse. This is often how sustainable rallies begin. Strong fundamentals quietly build, on-chain metrics light up, but price lags until it doesn't. Technically, XRP sits above all major moving averages, 50-day, 100-day, 200-day. Volume remains elevated. RSI remains high, yes, but rather than collapsing, it's resetting while price holds. That's a healthy consolidation, not a blow-off top. Burns rising during consolidation is like pressure building behind a dam. Eventually, either 1, the dam breaks and XRP explodes past $3.65, or 2, sellers try to flood out, but there's too much demand built in. Either way, the deflationary narrative just got a massive boost. The more XRP gets used, the more XRP gets destroyed, and the more appealing the token becomes to long-term holders looking for scarcity amid utility. This is the heartbeat of the XRP Ledger. And right now, it's beating faster than ever. The network isn't slowing down, it's warming up. And if these metrics keep rising, payment volume, burns, custody integrations, then price won't stay below $3 for long. It sounds outrageous at first. How could XRP, still trading under $5, surpass Bitcoin, the king of crypto, in minting millionaires? But that's exactly what some prominent voices in the crypto space are now suggesting. The bold claim. Crypto influencer Amonix recently made headlines when he stated, XRP will create more millionaires than Bitcoin ever did. Sharp. He doubled down, telling his followers to bookmark the statement and revisit it in a few years. It might seem like wild speculation until you zoom out. Bitcoin's rise from 0.5 SEF to over $120,000 produced thousands of millionaires and even billionaires. Early holders who believed in the tech, despite all the doubt, regulation, and crashes, were massively rewarded. So why are people now looking to XRP with the same level of conviction? Because they see a similar setup, but potentially with even greater utility. Why the XRP community believes. The XRP community has long claimed the asset is heavily undervalued due to regulatory suppression, delisted status during the SEC case, media bias toward Ethereum and Bitcoin. But now, that suppression is fading fast. Ripple's partial legal victory over the SEC, the incoming ETF approvals, the real-world utility from real estate to custody, and the increasing institutional adoption all suggest XRP is finally getting its moment. Combine that with the fact that XRP still trades around $3 to $4, and you get a belief among early holders that the wealth transfer hasn't happened yet. The idea is this: Bitcoin rewarded its early believers. Now it's XRP's turn. But can XRP actually reach Bitcoin-level gains? Here's where things get tricky. To match Bitcoin's wealth creation, XRP would need to rise to extreme price levels, often quoted between 100 and 10,000 plus per token. Let's break that down. A $10 XRP price? That's a $590 billion market cap, entirely realistic in a $5 trillion crypto market. 100 XRP? Now we're looking at $5.9 trillion around Bitcoin's potential future range. A 10,000 XRP, that implies a $590 trillion market cap, far greater than the total estimated wealth on Earth. So yes, 5-digit prices are mathematically far-fetched, at least in this decade. But 3-digit prices, according to some analysts, aren't impossible, especially if the XRPL becomes the base layer for tokenized assets, CBDCs, and cross-border banking infrastructure. Think about it. If XRP becomes the railway for global value transfer and Ripple controls regulated asset custody across real estate, stablecoins, and banking systems, then price is just a function of volume and supply mechanics. And XRP has built-in burn mechanisms, limited supply, and a growing use case across every sector that's about to go on-chain. XRP's millionaire math. Let's be real. So what would it take? If you bought 10,000 XRP at 30 cents, you spent $3,000. If XRP hits $5, you have $50,000. 10, $100,000. 100's $1 million. That's what many are betting on, not a $10,000 XRP, but a $50 to $100 XRP in the long term. Combine that with strategic trading, staking rewards, and early ecosystem exposure, and the idea of XRP creating a wave of new millionaires isn't entirely far-fetched, especially for those already in before mass adoption hits. So what are traders watching? If XRP breaks above 303.345, it opens the door to test 340, then 365 cents, the so-called Valhalla gate. If it sustains above that, analysts expect a possible move toward $12 to $23, with macro models projecting up to $15 to $23 over time. Volatility ahead? Yes, but the foundation is set. Now let's not ignore reality. The broader market is still fragile. US legislation like the Genius Act can tilt sentiment fast, and RSI levels suggest that a short-term cool down to $2.70, $2.80 is possible if sellers re-enter. But that doesn't change the larger trajectory. The burn rate, the ETF approvals, the real estate tokenization, the Ripple stablecoin, and the custody greenlight from US regulators all point to the same conclusion. XRP isn't just trending. XRP is transforming. In just 1 week, XRP unlocked Dubai's trillion-dollar real estate market, secured an ETF listing approval, gained US and custody clearance for banks, saw on-chain burn and volume metrics explode, approached the critical $3.65 breakout point, and all of this while Bitcoin struggles to reclaim 120K. Analysts say XRP is entering a new utility era, and once the Valhalla gate opens, it may never look back. So, if you're watching from the sidelines, know this, you're still early. But if XRP breaks above 365 cents with volume and institutional backing, that window might slam shut fast. Welcome to XRP's institutional age. The rails are built, the burn has begun, and the next millionaire wave may already be in motion.